3 a.m. Beijing time, and the Western world is asleep, completely unaware that in the span of 30 minutes, trillions of dollars are about to vanish from the precious metals market. Gold drops $500 per ounce, silver loses $15, and the largest single-day wealth destruction in precious metals history unfolds, while most Americans are dreaming about their morning coffee. And nobody in mainstream media is telling you the truth about what actually happened. Because this wasn't a crash, this was a coordinated reset. And if you understand what I'm about to reveal, you'll see why the next move in silver could be the most violent price surge we've ever witnessed. Let me show you what's really going on, starting with what happened on the surface, because the surface story is what they want you to believe. Silver had been climbing relentlessly through January 2026, breaking through $90, then $100, then pushing toward $120 per ounce. Numbers that seemed impossible just 12 months ago when silver was trading around $30, and analysts were calling everyone who predicted triple digits completely insane. And then it happened. In less than an hour, the price collapsed from nearly $100 to $22 down to $107, a $15 move in 30 minutes that defies every normal market behavior pattern we've studied over the past century of commodities trading. To put that in perspective, we just witnessed wealth equivalent to the combined GDP of the United Kingdom and France evaporate in less time than it takes to order a pizza and have it delivered. This doesn't feel real because statistically it shouldn't be real. A move of this magnitude in such a compressed time frame is beyond a standard Six Sigma event. It's off the charts historically, the kind of thing that should happen once in a million years according to conventional financial models. So what triggered this unprecedented collapse? And more importantly, what does it mean for what comes next? And why should you care deeply about understanding the mechanics behind what just occurred? Here's what the mainstream financial media won't explain, because explaining it would expose the entire paper-silver system for the fragile house of cards that it truly is. This was not organic selling from investors taking profits. This was not a natural correction. This was not investors suddenly deciding at 3 a.m. Beijing time that silver was overvalued. This was systematic, deliberate, traceable, and it follows a pattern we've seen before. The same pattern that appeared in 2011 and in 2020, a pattern that always precedes the next leg higher because it clears out weak positions and concentrates ownership among those who understand what physical metal actually represents. On January 7th, 2026, the CME Group announced it was hiking margin requirements on silver futures, raising the initial margin to $32,500 per contract, a staggering 47% increase designed to force immediate liquidation across the entire leveraged speculator base. Now let me explain why margin matters so much to understanding this crash. Because margin is the deposit traders must put down to hold a futures position. And when you raise that deposit requirement by nearly 50% overnight with minimal warning, you force traders to either add more capital immediately or close their positions entirely. Most traders cannot add significant capital at 3 a.m. when their banks are closed and their financial advisors are sleeping. So they're forced to sell, and when forced selling hits a thin overnight market with minimal liquidity and wide bid-ask spreads, prices don't decline gracefully in an orderly fashion. They collapse violently, creating the exact cascade of margin calls and liquidations we witnessed unfold in real time. This is exactly what the CME intended. They've used this playbook before in 2011, when silver approached $50 per ounce and threatened to expose the insufficient physical backing of paper silver contracts. They hiked margins 5 times in 2 weeks and killed the rally dead in its tracks. But here's what makes this situation in 2026 completely different from any previous margin-induced correction we've ever witnessed in commodities markets. Let me show you the divergence that changes everything we thought we understood about how precious metals markets function. Normally, when the CME raises margins and forces paper traders out of their positions, the physical market follows the paper price lower. That's how the system has always worked. Paper price discovery leads and physical market follows like an obedient child following its parent. But on January 29th, 2026, something unprecedented happened that completely shattered this framework. While COMEX silver crashed to $106 in New York, silver in Shanghai exploded to $149 per ounce at the exact same moment in time. Let me repeat that so it really sinks in, and you understand the magnitude of what I'm describing. At the precise moment, Western markets were crashing in panic liquidation, with traders dumping positions to meet margin calls. Chinese markets were hitting all-time highs with desperate buyers, paying $43 more per ounce than the Western price. A $43 premium is not a price difference you can arbitrage away. That's not a temporary dislocation. That's a complete fracture of the global silver market into 2 entirely separate price discovery systems, operating simultaneously on the same planet. One system controlled by paper derivatives in New York and London, one system driven by physical demand in Shanghai, and physical is winning this war. But why is China paying such extreme premiums for silver that Western markets claim is worth $43 less? To understand this structural shift, you need to go back exactly 29 days to January 1st, 2026. While the Western world celebrated New Year's Eve with champagne and fireworks, China quietly implemented the most significant change to global silver markets in decades, a change that will permanently reshape everything we thought we knew about precious metals pricing and supply chains. The Ministry of Commerce officially reclassified silver as a dual-use strategic material, placing it in the exact same category as rare earth elements, gallium and germanium, metals that China has already successfully weaponized against Western supply chains to devastating effect over the past several years. Under the new regulations, only 44 companies are licensed to export silver from China. Each must meet strict criteria, including annual production capacity of at least 80 tons, credit lines exceeding $30 million, and direct oversight from Beijing. And here's the critical detail that nobody is discussing publicly. In financial media, export volumes have been slashed by up to 40% compared to last year. China controls between 60 and 70% of the world's refined silver supply, so when the dominant global supplier cuts exports by 40%, you don't create a temporary shortage that can be resolved through market mechanisms. You create a permanent structural crisis. This is why Shanghai is paying $149 while New York crashes to $106. Chinese buyers understand what Western paper traders refuse to acknowledge. You cannot print silver, you cannot fabricate physical delivery when the vaults are empty, you cannot create metal from thin air. And when the world's largest refiner locks down supply, every single ounce becomes exponentially more valuable to anyone who actually needs physical metal. Let me show you what's happening inside the vaults right now, because the data is shocking and gets worse every week. Between early and mid-January, 33.45 million ounces of silver were physically withdrawn from COMEX warehouses for delivery. That happened in just 7 trading days. That withdrawal represents 26% of total registered inventory gone, not transferred between accounts, not relocated to different vault facilities, but delivered out of the exchange system entirely, taken by buyers who demanded real metal and will never return it to the trading float. COMEX registered inventories, meaning silver actually available for delivery against futures contracts, are now down over 70% since 2020. Let that sink in for a moment. 70% of deliverable silver has vanished in 5 years, and the withdrawals are accelerating, not slowing, meaning we're approaching a point where delivery failures become mathematically inevitable. But here's where the situation becomes truly alarming for anyone who holds paper silver claims thinking they own real metal. Silver lease rates, the rates institutions pay to borrow physical silver for short-term delivery needs, tell the real story. In normal markets with adequate supply, 1-month lease rates sit between 0.3 and 0.5% annually, barely noticeable, just the cost of doing business in commodities. As of January 2026, lease rates have exploded to 8%, with some reports indicating brief spikes above 100% during periods of acute delivery stress. This means borrowers are willing to pay 8% annualized just to guarantee they can take delivery of physical silver on time. And when someone pays that kind of premium to borrow metal, they're sending a clear signal to anyone paying attention. Physical supply and demand are severely out of balance. Having no silver is more dangerous than silver being expensive, and the market is willing to pay almost any price for guaranteed physical delivery. Now, let me connect this physical market stress to what the Federal Reserve just announced, because these systems are more connected than most people realize. On January 28th, the Fed held interest rates steady at 3.5 to 3.75% at their first meeting of 2026, and there were 2 dissenters. Governors Stephen Moran and Christopher Waller both voted for a rate cut. Both were appointed by President Trump, and their dissent signals internal disagreement about the direction of monetary policy that will only intensify as the year progresses. Chair Powell acknowledged the economy is expanding at a solid pace, but he also noted that inflation remains somewhat elevated above the Fed's 2% target. And here's the key phrase from the official FOMC statement that should concern everyone, quote, "Uncertainty about the economic outlook remains elevated," end quote. Translation: the Federal Reserve, with all its economists and models and data, doesn't know what's coming next, but they're worried enough to say so publicly in an official statement, and precious metals are responding to that uncertainty exactly as they always have throughout human history. Gold is now trading above $5,500 per ounce, up over 90% from a year ago. Silver is above $110, up over 250% year over year. These are not speculative bubbles driven by Reddit traders looking for the next meme stock. These are fundamental repricing events driven by structural supply shortages, genuine monetary instability, and the erosion of confidence in paper financial systems. But the Fed isn't the only force driving metals higher and creating structural demand for precious metals as a store of value. Let me show you the geopolitical pressure building beneath the surface that mainstream financial news barely mentions. Iran just warned it will, quote, defend itself and respond like never before, end quote, following fresh threats from President Trump regarding their nuclear program. The European Union confirmed it's officially designating Iran's Islamic Revolutionary Guard Corps as a terrorist organization, joining the United States in that classification. The United States has significantly increased military presence near Iran with naval assets and air power positioned throughout the region. Tehran responded by announcing live fire drills in the Strait of Hormuz, the narrow waterway that handles 20% of global oil shipments. When tensions escalate in the Persian Gulf, when the possibility of military conflict becomes real rather than theoretical, investors flee to hard assets, gold, silver, tangible stores of value that can't be sanctioned by governments, frozen by banks, or seized through regulatory action. This is why, despite the flash crash that made headlines, precious metals are already recovering to near their pre-crash levels, because the fundamental drivers haven't changed. If anything, they've intensified over the past few weeks. Now let me explain what the paper to physical divergence really means for investors, and why this represents a permanent structural shift rather than a temporary market dislocation. For decades, silver price discovery was controlled by COMEX in New York and the London Bullion Market Association. Paper trading volumes dwarfed actual physical supply by orders of magnitude. At one point, the paper to physical ratio reached 356 to 1, meaning there were 356 ounces of paper promises for every single ounce of deliverable metal in exchange warehouses. The system only worked because of one simple assumption that nobody questioned. Nobody would ask for delivery all at once. In early 2026, that assumption failed spectacularly. Institutional investors started demanding physical delivery, not paper settlements, not cash equivalents, not rollovers into the next contract month, but real deliverable 1,000-ounce bars. And the system couldn't handle even a modest increase in delivery demands. When you have 356 paper claims on every physical ounce, and even a small percentage of those claims demand actual delivery, the math breaks. COMEX inventory drains at an accelerating rate, LBMA vaults empty of available metal, Shanghai premiums explode because Chinese buyers are willing to pay whatever it takes to secure physical supply. And the paper price becomes increasingly disconnected from physical reality, creating the divergence we witnessed during the flash crash. This is exactly what we're witnessing unfold in real time. Let me give you the specific data you need to understand the magnitude of what's happening. LBMA silver holdings have dropped approximately 40% from their recent peaks. COMEX registered inventory is down over 70% since 2020. Shanghai inventories have fallen to their lowest level in a decade. The Silver Institute reports that over 1.1 billion ounces have been drawn from mobile inventory since 2019. That's metal that was readily accessible for trading, lending, and arbitrage, now locked up in ETF vaults backing paper shares, or delivered to industrial users who will consume it, or sitting in private hands of investors who understand what's coming and will never return it to the trading system. And demand is not slowing, quite the opposite. Demand is accelerating across every major consumption category. Solar panels now consume nearly 20% of annual global silver production, a percentage that grows every year as renewable energy capacity expands worldwide. Electric vehicles require significantly more silver than traditional internal combustion vehicles for electrical connections, battery management systems, and electronics. Artificial intelligence data centers are driving unprecedented demand for server components, circuit boards, and high-performance computing hardware that require silver for conductivity. 5G infrastructure requires silver for antennas, connectors, and signal processing equipment being deployed globally. Medical devices, defense systems, aerospace applications, every industry that the United States government says is critical to American economic security, and national defense requires silver as an essential input. This is why in late 2025, the U.S. government officially designated silver as a critical mineral, not a speculative commodity, not a traditional investment, but a matter of national security. When a government classifies a metal as critical, they're admitting something they'd rather not acknowledge publicly. We don't have enough, and we can't easily get more. Because here's the fundamental problem nobody wants to discuss honestly. You cannot increase silver supply quickly, no matter how high prices rise. Approximately 70% of silver is produced as a byproduct of copper, zinc, and lead mining operations. When silver prices rise, miners cannot simply dig more silver. They have to increase copper or zinc production, and those markets have their own supply constraints, economics, and investment cycles. New silver discoveries are declining globally as easy deposits have already been found and developed. Ore grades at existing mines are falling, meaning each ton of rock produces less metal than before. Development cycles stretch 7 to 10 years from initial discovery to commercial production, meaning even a discovery made today wouldn't help supply for nearly a decade. Meanwhile, demand grows every single day from sources that cannot easily substitute other materials. The Silver Institute estimates annual demand around 1.24 billion ounces in 2026. Total supply from mining and recycling around 1.01 billion ounces. That's a structural deficit exceeding 200 million ounces per year, roughly equivalent to the annual production of the world's largest silver-producing country. And that deficit has persisted for 5 consecutive years now. Where does the metal come from to fill this gap between demand and supply? Existing stockpiles, above-ground inventory accumulated over decades, and those stockpiles are disappearing at an accelerating rate, with no replacement source in sight. So what does this all mean for silver prices going forward? What scenarios should investors be thinking about as they evaluate this market? Let me give you the range of outcomes analysts are now discussing based on current data. Conservative case, silver stabilizes between $100 and $120 per ounce as the market slowly absorbs China's export restrictions and inventory levels find a new, lower equilibrium. This assumes no further supply disruptions or demand acceleration. Base case, silver pushes toward $150 per ounce as physical shortages intensify throughout 2026 and paper-to-physical divergence forces institutional buyers who currently hold paper claims to pivot into the physical market to guarantee actual ownership. Bull case, silver spikes toward $180 or higher if COMEX faces actual delivery failures and is forced to cash settle contracts for buyers who expected metal. Cash settlement is when an exchange admits it cannot deliver physical metal and pays you cash instead. This is the moment the entire paper-silver system loses credibility. The moment price discovery shifts permanently away from New York and London to physical markets where Shanghai and Dubai and Singapore set the real price based on actual supply and demand, not New York, not London, not paper derivatives. This is what Wall Street fears most. Once price leadership moves to markets that prioritize physical delivery over financial trading, the leverage and derivatives that have suppressed silver prices for decades become worthless as price-setting mechanisms, and prices adjust violently to physical reality. Which brings us back to the flash crash and what it actually means in context. Robert Gotottle, a former head of JP Morgan's metals desk, called it a, quote, long-awaited correction, end quote. He noted that corrections don't end bull markets, complacency does. The people who should be worried are those who sold at $107 in panic, thinking the bull market was over. The people who will profit are those who understand this crash was artificial, margin-induced, paper-driven, and temporary. Because while COMEX was crashing, Shanghai was surging to record highs. While Western speculators were being liquidated by margin calls, Chinese buyers were accumulating physical at premium prices. While paper traders panicked about a $15 drop, physical inventories kept draining at the same pace as before. The divergence tells you everything you need to know about where this market is heading. Paper price and physical reality are separating, and in that separation, physical always wins. It just takes time for the paper system to break and acknowledge reality. Now I want to address something you may have seen in headlines about mints and refiners running out of silver. The reports are mixed depending on which source you read. Some dealers report backlogs extending into April and May for certain products. Others are still shipping normally with minimal delays. But wholesale premiums have spiked significantly above historical norms. And when premiums rise sharply, it means physical metal is commanding a higher value than paper spot quotes suggest. That premium is real demand telling you the paper price is wrong. Pay attention to premiums, not just spot prices. Premiums tell you what buyers are actually willing to pay for metal in hand versus a paper promise. And right now, those premiums are screaming one consistent message across global markets. Physical silver is scarcer than the paper market admits, and the gap is widening. So what should you take from everything I've shown you today? First, the flash crash was not the end of the bull market. It was a forced reset. Weak hands liquidated, strong hands accumulated, and the structural shortage that's driving this market remains completely unresolved. Second, China has fundamentally altered global silver supply chains. The January 1st export restrictions are not temporary measures. They're strategic policy, and they will only tighten as China prioritizes domestic industrial needs. Third, paper and physical markets are diverging in ways we've never seen before. Shanghai pays more than COMEX. Physical premiums exceed paper quotes. Lease rates are at crisis levels. These signals all point in one direction. Fourth, geopolitical risk is rising globally. Iran, tariffs, questions about Federal Reserve independence. Every source of uncertainty drives demand for hard assets that exist outside the financial system. Fifth, silver remains historically cheap relative to its 1980 inflation-adjusted high. At current prices, around $110, silver would need to reach approximately $190 to match that 1980 peak in real terms. We may be nowhere near the actual top of this cycle. The pattern is clear for those paying attention. This flash crash wasn't a warning to sell. It was an invitation to understand what's really happening beneath the surface. The system is breaking. Paper is losing control over physical markets. Physical demand is overwhelming available supply. And those who recognize the pattern will be positioned for what comes next. Stay informed about the real data. Stay prepared for continued volatility. And I'll see you in the next one.